Okay, welcome everybody to this Thursday lunchtime webinar. Today's webinar is going to be on basic technical indicators, a very important concept in trading the financial markets, as well as the fundamentals. The technicals are also very important and will aid you and benefit you in the long run with your trading accounts. So what can indicators do for you as a trader? First of all, they can assist you with calculated trades. No one wants to get into the market guessing. Obviously, as an account manager myself with many years experience, I would not recommend any trader to get into a trade purely based on a guess or an assumption. Statistically, you'll get 50% right and 50% wrong. For me, that ratio is way too low, and what we want to do is we want to get into the market with calculated trades, and obviously the fundamentals of the market, the news announcements, the eco calendar, will help you with that, but also the technicals of the market as well, and I wanted to go through some of the basics with you of that. Indicators can also confirm predictions. So for example, if you've done a bit of homework on the markets and you show that the euro is going to go up, for example, the dollar is going to weaken, indicators will help you confirm these predictions or these assumptions. So it'll make your life a lot easier if you're looking at certain technical lines or movements in the market that will confirm your thoughts. And indicators can and should be used in conjunction with your fundamental analysis. Very important. So as a beginner trader, I do recommend that you look at the fundamentals, so all the news announcements, in conjunction with some of the technicals of the market, so your basic indicators that I'm going to go through. There's three main indicators that I'm going to go through, the moving average relative strength index, also known as the RSI, and the Bollinger Bands. Now, there's a lot more indicators that we do offer, and in the next few weeks I will be going through more of those indicators in detail, the ones that I haven't touched. But for now, I'm going to go through these three basics, very straightforward, and I do recommend that you guys start implementing these into your charts and your platforms as soon as possible. The purpose behind these indicators. So what do these specific indicators do for you? What's their purpose? Well, first of all, a moving average indicator, whether it's an exponential or a simple moving average, is a trend following tool. Bollinger Bands, a profit taking tool. Also measures volatility, lets you know as a trader what's happening in the market if something's happening. And the RSI, the relative strength index, is an overbought or oversold tool. We're going to go through all of these in detail, and then I'm going to go and show you how to plot them onto the MT4 platform itself. Okay, we're going to start off with the moving average crossover. It's the most basic type of crossovers, and it's when the price of an asset moves from one side of a moving average and closes on the other. Okay, so we're talking about a candlestick movement here. So we're talking about a candlestick movement crossing below the moving average will be a change in direction of the trend. Price crossovers are used by traders to identify shifts in momentum and can be used as a basic entry or exit strategy. So using this moving average crossover will give you a better indication of when to get into the market and get out the market. Let's have a look at what it looks like. So here's the basic moving average crossover. As you can see written here, notice how the moving average stays well below the trend on the way up. So you can see it's almost like a support, just follows it underneath, and as long as the trend is underneath, it's an indication of an uptrend. And you can see that the closing price of each candlestick is always above the moving average, and by the way, this is a 20-day moving average. Okay, you can see it says MA20. And what the moving average is, it's an average over the time period, specific time period of the highs and lows and opens and closes, and that's basically what the moving average does plot on the graph for you. So the arrow on the chart here, you can see this is where the crossover is. You can see in this black circle, you'll see that the candle is now closed below the moving average, indicating the beginning of a new trend, and more specifically, the beginning of a downtrend. So let me repeat myself again. As you can see on the way up, clear upward trend, the moving average is just supporting the candlestick, the trend's on the way up, and as soon as you see that that black arrow where the candlestick has closed below, down below the moving average line, you'll see that the uptrend ended and the downtrend began. So at this point, it would be an indication for you guys to prepare for a sell trade, for example. Pretty straightforward. Here we have the second type of a moving average. It's called the double crossover. Now, obviously, it's personal preference to which traders which one they prefer. Some prefer the simple one, which is just the one moving average of the short term, and some people prefer this one. So, guys, it's up to you, and I can always give you my recommendations, and your account managers can also give you theirs. So, the second type of crossover occurs when a short-term average crosses through a long-term average. Therefore, a buy signal is generated when the short-term average crosses above the long-term, while a sell signal is triggered by a short-term average crossing below a long-term average. I'm going to show you the graph at the bottom, and you can see why it's such a popular moving average indicator to use. So again, pretty straightforward. The only difference this time is you're using two different moving average lines. One is short-term, one is long-term. You can see the blue is the short-term. It's a 15-day moving average. And the red is the long-term, a 50-day moving average. So long and short-term. As you can see, the market's not doing too much in the beginning, while the two moving averages are far apart from each other. But as soon as you see the moving average short-term crossing above the long-term 50-day moving average, you can see that there was a clear upward trend occurring. Okay, so notice how the short-term average crossing above the long-term average signals the beginning of an uptrend. Pretty simple. This is not rocket science, guys. It's very straightforward, and it'll help you get into the market and also get out of the market at the right time, or at a better time than what you would have done without it. So once again, you can see the double crossover is involving a short-term moving average, the 15-day, and the long-term average 50-day. Now, don't forget, you can do a 10-day, you can do a 14-day, you can do a 50-day, 200-day. It's pretty much the same concept, but my recommendations would be to keep to these parameters. So pretty simple stuff, and your account managers can go through it with you again. I do recommend that you do implement the moving average into your trading strategies, whether it's a live account or a demo or both, and start getting used to identifying the crossovers in the charts. The next indicator I want to speak about is the relative strength index. As you can see here, it's an indicator that you have at the bottom of the chart on the platform, and it has three different areas here. It has overbought. As you can see on the chart, that's between 70 and 100. It's known as overbought territory. What does that mean? It means there's many buyers in the market. 0 to 30, you'll see that is oversold territory, an indication that there are many sellers in the market. And then therefore, the area of 30 to 70 is known as the ranging market level of equilibrium. Many sellers and many buyers in the market at the same time. Now, what does this indicate to you as a trader? Obviously, when the market goes into overbought territory, it's an indication that there are too many buyers in the market, and a correction or rebound in the market is likely to happen. So once you see the line lagging in overbought territory for a certain period of time, you know that's an indication that it's highly overbought. There's too many buyers. Let me prepare myself for a sell trade. Okay, and exactly the same thing applies for the oversold territory. When there's too many sellers in the market and the price, for example, is too low, for example, let's say the rand is very low against the dollar, or the euro is very low against the dollar, you're going to see it's in oversold territory. And usually what you do find is that the markets do rebound and correct themselves, and that's exactly what this helps you with. It helps you identify potential entry and exit movements. Again, just like the moving average. And it's an identifying indicator. It helps you identify future movements in the market, so it'll be easier for you guys to get in and out of the market with a buy or a sell trade. And bearing in mind, when the market is ranging, obviously there is still movement in the market, but ideally what you want to do is you want to really get in and out of the market when it's overbought or oversold, and that's really what the purpose of the RSI is. So just for an example, if the euro is very high against the dollar, it's going to be in overbought territory. If the euro is very low against the dollar, it's going to be in oversold territory. If the euro is ranging against the dollar, not too much movement, up and down, it's going to be in ranging market. Okay? Here we have Bollinger Bands, ladies and gentlemen. This is a trend following, a profit-taking indicator, as well as a volatility, measuring volatility indicator. Okay, it tells you when there's something happening in the market, And Bollinger Bands basically have three lines. Okay, it has an upper band, it has a middle band, and a lower band. Now, the reason why it is known as a profit-taking indicator is that when the candlesticks or the price of the market gets close to the upper band, the upper Bollinger Band, it's an indication to take your profit, get out of the market. And vice versa. When the price or the candlestick reaches the lower Bollinger Band, it's also an indication to get out of the market with your profit if you have a sell trade. If you have a buy trade, let the market reach the upper band or get near it and then get out of the market. Okay. Obviously, I wouldn't recommend using the moving average and a Bollinger Band at the same time because it's pretty much the same sort of concept, and too many lines on the screen might confuse you. Just make sure if you do want to use the Bollingers and the moving average, you can obviously differentiate from the two. You can make the moving average a thicker line and a different color, so you can see it very clearly in comparison to the Bollinger Bands. And also, the Bollinger Bands are close together when the market is quiet. So when there's not much happening in the market, you'll see the bands are quite tight together, all three. So you can see in the middle here, just to the right where it says lower band, just to the right, you see it's quite tight together, not too much happening. And all of a sudden, you saw the euro jump up against the dollar here for about half an hour, and you saw the bands expand and get wider and wider apart. That's an indication that there's something happening in the market. So the Bollinger Band is telling you, trader, please pay attention to me. There's something happening in the market. It'll be a good time to get into the trade. Now, there's no point as a trader getting into the trade when the bands are at its widest. You want to start looking at getting into a trade when you see the bands slowly getting wider and wider. So just before this big spike candlestick here on the 4th of September at about 3 o'clock or 4 o'clock in the afternoon, this is where you want to prepare yourself to get into the trade. You don't want to leave it too long because you'll miss the opportunity. At the same time, you don't want to do it too soon because maybe there won't be any movement until a couple of hours later. So the Bollinger Bands measure volatility. They let you know if something's going to happen. And this is an ideal indicator for profit taking. Like I said, if you're in a buy position, for example, euro-dollar, and the price is reaching the upper Bollinger Band, it might be an indication for you to take your profit and get out of the trade. On the other hand, vice versa, if you're in a sell position and you want to aim for the price or the candlestick to reach that lower band and then get out of the trade with your profit. Okay, the most important thing I'm going to go through with you guys is basically plotting the indicators on your charts. Now, we also have the indicators available on the web trader. That will be discussed with you. If you do prefer the web trader, you can discuss it with your account manager this afternoon or even tomorrow, and they will happily show you how to plot the indicators on your web trader. But I'm going to go through the MT4 platform because the majority of our clients use the MT4. Okay, as you can see, this is what the moving average, 20-day moving average looks like on my chart. Okay, as you can see, I made a bit of a thicker line here so you can see it nice and clear. And what I've got here actually is a perfect example of a moving average. And as you can see, right at the top here, you can see when the euro-yen, when the candlestick closed below the moving average, you saw a clear downward movement here. And then you see an upward trend, and you see, again, just like the figure I showed you on the presentation, that the moving average will always follow underneath and support an uptrend. And always look out for crossing downwards of the candlesticks when they close below the moving average, indication of a downtrend. So this is a perfect example of the moving average 20-day crossover. And like I said, clearly you can see here, if I use my crosshair, you can see right over here on 9:45 on the 4th of September, you can see that the candlestick closed below the moving average, indicating the end of the old trend and the start of a new downward trend. Okay, so you obviously open up a sell position, and then you see the candlestick slowly moving into an upward formation, causing the moving average to just support the closing prices until, again, over here on the 5th of September, so today, early this morning, 5:45, 6 o'clock in the morning, you saw that there was another downtrend created through the crossing of the candlestick closing price underneath the moving average. So very simple stuff, very, very important and very effective. Now, I'm going to show you how to plot this quickly on the graph. So first of all, you have your graph here up, and first of all, I recommend that you maximize your charts in the first place. Otherwise, you won't be able to use your indicators effectively. You won't be able to see it properly. So what I'm going to do is I'm going to click on Insert, Indicators. So quite a big list of indicators come up here, and what you want to look for is the moving average is a trend indicator. The moving average box will then appear, and it's up to you to sort out your parameters. Now, if you look in the period, I've got 20 days. If you prefer, you can have a 50-day moving average, which is a bit more long-term. If you're a bit more of a longer-term trader, you want a bit more long-term moving average, you can make it a 100 or a 200-day moving average by simply changing the figure in this period column. My advice to you would keep the method, the MA method, the moving average method, as a simple moving average for now, and always apply to the close of the trades. You could, if you wanted to, you could apply to the open, the high, the low, the median, whatever you like. But for me, this example is applying to the close. The style of the moving average, obviously, you can change the color to make it stick out and make sure that you can see it nice and clear. There's no point having a white moving average if your chart is white. You're not going to see it. So always make it nice and clear. So for example, I've got a dark blue, and I've chosen a very thick line here. I've chosen a thick line so it sticks out. Also, what you could do is you could change the lines to make them dotted or patterned, and that can also stick out. So always make sure that you can see it nice and clear. So I'm going to make mine, let's make mine actually a dark turquoise color. Okay, let's check my levels. Don't need to change anything here. Visualization, make sure that all the time frames are checked. If not, you uncheck the box and you only make the moving average available for the specific time period that you want. Some of you might prefer only to look at a 5 minutes or a 15. Some of you maybe a daily and a weekly. Depends if you intraday traders, you're in and out the market, or if you're longer term. So what you want to do is you want to click on all time frames. Okay, and there's my moving average, as you can see. Pretty simple stuff. Like I said, insert, indicators, trend, moving average. Okay. Now, if you want to get rid of the moving average, you simply right-click the mouse on the actual line, delete indicator. Pretty simple stuff. Okay. Now, that's the first crossover. Let's talk about the double crossover. What you would have to do is you would have to plot two different moving averages on the graph. Okay. So let's do the first one. Moving average. If I remember correctly, the short term was a 15-day moving average, and that was in blue. Okay, there it is. Now I'm going to draw my 50-day moving average, the longer term, to complete my double crossover moving average. And let's make this one a red one. Okay, so here's my long-term and here's my short-term moving averages. And as you can see, there are some examples of movement here. And also an indication, if you look at this area over here on the 5th of September, you can see that when the moving average short-term crosses below the long-term, it also could be an indication of a downward trend. Okay, so also keep that in mind. Always look for the crossovers. It's not written in stone, ladies and gentlemen, that you're always going to see a perfect crossover and a perfect change in direction. But this is what you need to look out for. When the short-term crosses above the long-term, indication of an uptrend. When the short-term crosses below the long-term, it could be an indication of a potential downward trend. Okay, so always plot the two different moving average if you want to use the double crossover. So once again, it's personal preference, up to you as a trader which one you are more comfortable using. Okay. Now let's move on to the RSI. I'm looking at a 1 hour gold chart here, and you can see the RSI at the bottom. You can see the 0 to 30, 30 to 70, and 70 to 100. These are my levels. 0 to 30 oversold, 70 to 100 overbought, 30 to 70 ranging market. Okay, so obviously it works in tandem with the chart. So if the chart is up, you'll see that as you can see over here in this area over here, you will see that a bit of a bullish move for gold. And if you look at the RSI at the bottom, you'll see at that exact period in time, you will see that the RSI movement was bullish as well. And if it goes down, you can see that gold's movement was a bit bearish as well this end of yesterday, and you can see that it had an effect on the RSI. So how do we plot this? Okay, first of all, insert again. All the indicators are under insert. Don't forget that. Okay, what you're looking for is an oscillator. The RSI is an oscillator, ladies and gentlemen. Don't forget that. Relative strength index. And what I do recommend, take note of the parameters I use here, the 20 days. Some people use the 14. I recommend the 20 just for now, default. And again, apply to open or close, whichever one you like. I recommend opening. And make your color very visible. Make it clear. Okay, so for example, let me use I'm going to use a black line. I'm going to make sure it's nice and thick. And visualization, again, applying to all time frames. And I'm going to click OK. And here's my RSI. So you can see on the 31st of August or the 30th of August, you can see a bit of a lagging in oversold territory, but it didn't stay there. It carried on up, and eventually it went into overbought. So a perfect indication of identifying a potential trade is at this stage over here on the 30th of August. You can see at the bottom here that at this point, okay, too many sellers in the market, time to get into a buy position to prepare myself for a rebound or a correction in the market. And a couple of days later, you would have made money if you bought at this level here because it went into overbought territory. And likewise, you can see when gold was bullish, it was in overbought territory. It came back down again to trade in oversold or very near the oversold line. Okay, so an indication for you guys is not necessarily if the market touches overbought or oversold. Really, what you're looking for is you're looking for if it's been in oversold or overbought for a certain period of time. If it's been lagging there for a couple of hours, a couple of days, it's an indication to get into the market. The markets are going to rebound. There's too many buyers in the market, time to sell. Too many sellers in the market, time to buy. Pretty simple stuff. Okay, if I want to get rid of this RSI or if I want to change the properties, I right click, I click on RSI properties, and I can change my parameters. Okay, I can change my colors. If I want to get rid of the indicator, delete indicator or delete indicator window, and then it's gone. Okay. The third and final indicator I want to go through with you guys is the Bollinger Bands. As you can see, I'm looking at a 15-minute time frame GBP USD currency pair. It's known as a cable as well. And as you can see here, guys, perfect example when there's volatility in the market. So as you can see, the clear bullish line here, the Bollinger Bands were wide apart. They expanded significantly, indicating to you as a trader an opportunity in the market. Okay, and when the bands are close together, as you can see early this morning, wasn't too much happening. The bands were close together, an indication that the market is relatively quiet. Probably not the best time to get into a position. So what you want to look for is you want to look for the bands slowly starting to expand, which is an indication for you to pay attention to the market. Like I said, the Bollinger Band is telling you, trader, please have a look. Something is happening in the market. Please prepare yourself for a position. Okay. Again, pretty simple stuff, not rocket science by any means. And like I said, the Bollinger Band is a profit-taking indicator. So if you've got a buy position, what you want to do is you probably get into the market around this level over here, purely based on the fact that on the 4th of September at 9 o'clock, you saw a clear bullish move, okay, around this level over here. So at this level, you'll start to see and notice the bands expanding. At this point, probably around here, you'll get into a buy position. Okay, like I said, if you get into a buy position, you take your profit when the candlestick reaches the top Bollinger Band or breaks through. That's your take profit level. Okay, and vice versa for a sell position. Wait till your sell position touches the lower Bollinger Band or gets near it to take your profit. So a perfect example here, ladies and gentlemen, when you see a bit of a change in direction, a bit of a bearish move now for the pound against the dollar, you're probably at this point here, 5 o'clock on September the 14th in the afternoon, probably take your profit on the sell trade purely for the fact that it's very near the lower Bollinger Band. Okay, so that is why the Bollinger Band is an excellent take profit tool. Also, what I want you guys to keep notice of, a little trick for you guys, basically, when you see a lower Bollinger Band, a candlestick, sorry, crossing below through the lower Bollinger Band, it's an indication of a correction in the market. So as you can see here, for example, near the 5th of September, 9 o'clock, around this level over here, you'll see that the candlestick started to break through the lower Bollinger Band, indicating an uptrend. So it took a bit of time, but nonetheless, there was a reversal and the market went back up. Some people do say an indication also the other way around. When the candlestick touches and breaks through the top Bollinger Band, it's an indication that the market will correct itself and move in the opposite direction. So again, not written in stone, but guys, do look out for candlesticks breaking through the bottom and candlesticks breaking through the top Bollinger Bands. Okay, now, if I wanted to have more than one indicator on my chart, no problem. I've got my Bollinger Bands here. I can go to Insert, Indicators, look for my RSI, plot my RSI, and there you go. So as you can see, ladies and gentlemen, 11 o'clock on September the 4th, a clear bullish move for gold. Gold was extremely volatile, indicating too many buys in the market, time to sell. As you can see over time, it's a short-term time frame, so it didn't take too much time for the market to correct itself and go back to trade near, on the 5th of September, 24 hours later, near the oversold territory. So this is a clear indication that the RSI will help you identify future movements in the market. And I really, really recommend that you guys start implementing these basic of basics indicators to help you. And even some professional traders, they're not using these alligator theories and Elliott waves and things like that. They're using the basic Bollinger Bands, moving averages, and the relative strength index. I really do recommend you start using it if you don't already. And please use it in conjunction with your fundamentals. And the reason why the fundamentals are so important is because regardless of your technical indicators, you know, big movements in the market can be caused by news. For example, the unease and the tension in the Middle East at the moment with Syria and events like that, you know, really affect the price of gold. Gold has really had a nice move up, a nice clear bullish move, because gold is known as a safe haven asset. And during times of economic difficulty or war or anything like that, political, people will invest their money with gold. Okay, so the fundamentals will move the market regardless of what the technicals are saying, but sometimes the technicals are most useful when there's no announcements coming out. So if you want to get into the market and there's no fundamental announcements coming out, you can look at your Bollinger Band, you can look at your RSIs, you can look at your moving average crossover or double crossover, and you guys can get into the market with a calculated trade. So you don't always need to rely on fundamentals, but it's important to use both together with your trading strategy at all times. Okay, and so this basically concludes my webinar. It's a very brief webinar, and please guys, if you have any questions, please write them down. Your account manager will give you a call tomorrow or this afternoon. You can contact them yourselves and go through everything. Please remind me of times which will suit you guys for future webinars. If the afternoon is better for you guys, the mornings, the evenings, please let me know. Your feedback is much appreciated. And please keep in mind some potential market movement today with the dollar, and tomorrow afternoon with the non-farm payroll report. And I will leave this open for 5 or 10 minutes for all your questions to come in. Thank you very much for attending, and I will see you in the next few weeks.